कराए Rajnish ji. You can proceed with your session, and I'm sorry for the interruption and the delay. Please, mic is yours. Vishwanathan ji. Vishwanathan ji.
I'm there, I'm joining. Can you hear me?
Yes, sir.
Yeah.
Yes. Okay, so we have been given 25 minutes to find funds for infrastructure projects. And the size of the funding which is anticipated over a 10-year period is $500 billion. So I won't spend much time on the introduction because Mr. Rajkiran Rai, Mr. Vishwanathan, Shaurya, Doval, Sanjiv, Aggarwal, they all are top-class finance professionals having experience in either raising funds or lending money, or Mr. Vishwanathan, who has been the regulator and was keeping an hawk's eye on how the banks function. I have first-hand experience of working with Mr. Vishwanathan, Mr. Rajkiran Rai, and in fact, I was IBA chairman when the idea of forming NaBFID was conceived. Rajkiran Rai was also in IBA when we prepared the blueprint for NaBFID. So if we are talking about, say, 500 billion over 10 years, and when there are multiple countries involved, from India being one of them, but Middle East and Europe. So 50 billion per year, let me put this way. So Rajkiran Rai, is it a big money or not so big, but what are the issues or challenges which could come, or what can be done so that the project becomes successful?
I feel, many times the size of fund required is highlighted, but money is not a problem. We were doing 10 gigawatts of renewable. Now we are reaching close to 30. We are aiming to reach 50. We never found financing. It is mostly happening from the private. But we never found lack of money for doing these projects. So I think if you have got the right projects with the right models, where the repayments are planned, proper concession agreements are drafted, so I think raising money for right kind of projects will never be an issue. So we actually today when we talk, the asset under management of long-term liabilities, what we call insurance, pension, PF, has reached a size of 115 lakh crores. And they are growing at high double digits. That means we are adding 15 to 20 lakh crores every year in these long-term liabilities like insurance, pension, and PF. And actually, we have to find a way that these long-term liabilities get invested in these kind of projects, and there is a good possibility because NaBFID is, in the last 2 years, we are working on that. We are already working on a product like partial credit enhancement, which will further enable development of bond markets and bringing this money to these sectors. So only thing what we need to do, there are a lot of learnings in the last cycle, which is, in the last 10 years, we have seen that. Today, if you see the default rate in infra projects is less than 1%. And when we did a study of about 2,500 accounts, for the investment grade in infrastructure companies, the default was almost zero last year. So that means we have got our act right now. Why this has happened? Very strong counterparties. The success of NHAI on the road sector, the success of power grid on the transmission sector, The success of SECI in the renewable sector as strong counterparties has attracted investment. And then the strong concession agreements. We have actually fixed all those loopholes which resulted in bad assets or not getting the correct revenues. It's all sorted. It is not the end actually, it has to continuously improve. But my point is, if you are able to get your policy right, your concession agreement right, and have a strong counterparty, attracting investment to this sector is not an issue.
So, if I have heard you right, you mentioned NHAI. This is an India experience, but this is going to be an international experience, international projects, where one major complication would be around the geopolitics. In India also, like in any country, the political risk is always there, and whenever project financing is done, the lenders do keep in mind what is the political environment in the country, how stable it is, but here the complication could be much more because of the geopolitical situation. But the point which you raised is that a strong counterparty, and a strong counterparty means either government or government support. So without a strong counterparty, finding money may be a bit difficult. That's what you're saying.
Investors are not very confident when the counterparties are not very strong, actually. So because these are large projects, basically. You know, when we talk of this particular Indian, Middle East and European corridor, actually there are geopolitical risks, like there are different countries involved, different projects involved, actually. This is as Minister Sir was saying, it is not a simple road project or a rail project. It is a combination of project, which is called economic corridor. That way, I think nothing of this size and this diversity was never planned, actually. The first time we are planning. It is all new for us. We need to split it into small parts now. Actually, as a banker, when I look at it, it's a concept-wise, we are just trying to crystallize the thought process around this, that how to plan, how to get different countries along, what are the financing options and all that. For a banker, I will look at it in a more critical way. I need to split into different projects. For me, road is a different project, rail is a different project, gas pipeline is a different project, digital infrastructure, your undersea cables may be a different project. There are different parts to it. So everything is different. Actually, the financing models are different, the revenue streams will be different. So we need to get it actually, because the kind of conversation and the kind of participation, high level of participation, the ministers coming and blessing this, actually shows the political will of getting this through. The ambassadors of different countries coming here, it gives a very clear signal that everybody is interested in getting this through. So when there is a political will, other things will fall into place. We are the people who will ultimately convert into reality, but then the concepts, the policies, the structures, they have to be created, that how the different governments will interact with each other, what are the common policies needed, how this economic corridor ultimately, that generates the revenue. Because whoever is funding this project, he is calculating that when he will get his money back and what is the return he is going to get, and whether my money is safe. If you are able to give that comfort, the flow will happen. So, but then it is a much complex product. It is not as simple, these are the models we talk about within the country, where our government came in, our regulators came in, they fixed the issues. But then, as we go look at international, they are much more complex than what we think, and maybe our role will come once all the structures are done. Then we can come with the, how this can be financed and what are the, there are multiple models of financing of infra, which has emerged over a period of time, very successful models. But the solution will come only when you show us the project, this is the typical project which has to be funded. What can be the right financing model we can look at.
Yeah. But I think for your institution, a lot of opportunity unfolding in next 10 years.
I think this institution itself is created with that idea, because we are well funded, actually, well capitalized, and because one of the basic issues with infra is lack of a specialized agency. NaBFID has filled that gap, being a very specialized agency funding infra. We also do policy advocacy. We also, because one of the mandate for us is developing bond market, crowding in investment, which perfectly suit with the IMEC. So I think maybe when I listen to the speakers here, I understand that NaBFID has a big role to play here.
Right. So you will be providing more of debt capital, but let me come to Sanjiv, because you are another important institution, NIIF, set up by Government of India, to support the infrastructure funding in India. And NIIF has been able to raise a lot of funding from the Middle East. That is what, if I've understood it correctly. So what is your experience so far, and what role you envisage as far as IMAC is concerned?
Sure. Firstly, thank you very much for inviting me to this conference. On NIIF, we are 49% owned by the sovereign government of India. 51% were owned by international investors, and the mandate given to us by the Indian government is that we need to raise 51% of the capital of every fund from international investors, and we are to invest on a pure commercial basis. On IMEC specifically, if you look at the entire corridor, as Rajkiran said, it's a bouquet of interlinked projects, right? So firstly, we need to break down the entire corridor into a number of individual projects. And then I would suggest that we look at those projects which can perhaps be commercially attractive to equity investors on a standalone basis. Now, for example, one of the key aspects of the IMEC is to establish ports or new facilities, new terminals at existing ports in the country, right? Perhaps, I don't have enough data to say, to thump the table and say that, but perhaps, setting up a few large terminals, a couple of large ports on the western seaboard of India, could that be commercially attractive enough for private equity capital to come in? Perhaps. So that is one set of projects which could be done on a so-called standalone basis. But then you again look at, for example, the rail trunk line that is required to be constructed. Can that be done in a manner that it attracts private capital, equity capital? I would suggest that perhaps no. That is a part of the infrastructure that needs development capital which can come from the government to do that. Likewise, we need to look at each of the individual projects, and here we got not only a project on project risk, but project on multiple project risks, right? So it will be very important for us to have an adequate risk sharing mechanism in the events of some defaults happening. We'll need obviously multiple governments. I see people from the World Bank and IFC, etc. here. They could play a role in ensuring an adequate risk sharing across the entire chain. That's how I look at it.
Thank you. Mr. Vishwanathan, I will come you to the last because regulator always has the final word. So,
Okay.
Shaurya, coming to you. Shaurya Doval is there online? No, he's not there? Okay. So then, like before I come to Mr. Vishwanathan, in India, and maybe Sanjiv, you can throw some light on this, InvITs is gaining ground. And so far it has been in domestic currency. Can there be a model built around InvITs?
See, if you look at, Mr. Kumar, if you look at the InvITs, the underlying principle of InvITs is that the investor in the InvIT does not want to take any construction risk, right? These are all operating assets, and he's investing to get a short set of cash flows. So what I would argue is that an InvIT could be a capital market route for exit maybe a decade down the road once the projects have established their, for example, if it's a road project, the traffic pattern has been established. If it's a renewable project, then the offtake, etc., has been established. So yes, certainly as an exit route, but not as a primary route of funding.
Right. So that capital will come at a later stage. First, we need to find capital for the
That's right. More as a refinancing, if I may use that term.
Yeah. So, Mr. Vishwanathan, we know the kind of experience, not so good experience, I would say, when banks, commercial banks in particular, had a problem and burned their fingers by financing infrastructure projects in power and road sector. And you were at the helm of affairs when all the cleanup and the banks were trying to resolve those issues. So based on your experience, and as Sanjiv mentioned that once the construction is complete, then InvITs could be instrument for refinancing or releasing the capital. But for construction, who will take the risk? And whether commercial banks in India or other countries, whether they can take such risk, or what would be your guidance and advice on this, considering the complexity of the projects?
At one, I think this is a project of one of its kind, multi-countries, multi-projects. And I think I like the idea which Sanjay mentioned, that it's important because see, there are linkages. Certain projects will not have any money unless it is linked to the other project. But identifying those projects which can develop on its own, create income on its own, without depending on another country or another project to fructify, is something that one must look at. And that is what possibly banks can get it. I mean, they will have construction risk, of course, but I think that will be much less as opposed to where you have multiple countries having to work together, number one. Number two, I think, as you said, banks have burned their fingers, and now they are, I think, they have learned their lessons. Hopefully, they have learned their lessons. Number two. Third, is that I think it's an interesting point that we must understand, Rajnish and all of this, that over a period of time, this is a phenomenon that I think is very clear now. Bank deposits are not the only source of savings for public. The monies are going to capital market in the form of mutual funds and insurance products and things like that. So I think therefore going forward, the role of banks in financing heavy capital intensive projects will have to come down, and their role has to be taken by the capital markets, whether it's a bond or equity. And I think, I mean, your success as the current chairman of SBI, he said that for India to become a Viksit Bharat, we need 1,000 lakh crores. And he has very clearly said that only a third of it will come from banking sector. The remaining has to come from the capital market. So I think that will how the financing of these projects have to take place. But I still believe NaBFID has a little different kind of a role as NIIF, as opposed to banks. The banks are dealing largely with public money. They have, the typical refinancing risk that, they have. And therefore, I would not say that banks will be absolutely, unready to finance these. I think there are good projects which are properly framed, end-use ensured, a proper, risk sharing, properly documented. I think there will be banks which are willing to do, because banks, I think, there's also a need among the banks to move away from pure personal loans. Okay, so they also need to have diversification of their asset portfolio. But I think nobody would want to rush to a project of this kind and of this dimension unless they are sure that the risks are already taken care of. So I would say that it will be a third funded by banks and largely funded by the capital market. And that's where I think, I'm talking of another regulator, well, I'm the ex-regulator of RBI, maybe IRIDA and others will have to look at how do they enable those monies to get channeled to these kind of projects, is what I believe. And I think another area where banks can come in, Mr. Rajnish and even Mr. Sanjiv, is that maybe they can come at the refinancing stage. Apart from InvITs, the banks, once there is a assured cash flow, the banks can take that risk. So that's another place where they can come in. Maybe they can even come at a lower interest rate than maybe what InvITs are expecting in terms of return on investment. Okay, so I think it will be a melange of funds, but fundamental risks of construction will have to be taken by the capital market, and banks will actually part fund it. That's how I see it.
So, like in essence, if we have to find capital for the construction period, because once the construction is complete, then risk gets mitigated to a large extent. So, how do we mitigate the risk during construction period so that the project becomes a bankable project? Any suggestions, Sanjiv? We did try with security bonds, and construction insurance, security bonds. And the other issue which Mr. Vishwanathan alluded is right now, insurance companies can't invest unless it is AAA bond.
So if you, I'll talk more in the context of, I'll talk more in the context of India because that's the market that I'm familiar with. Construction risk is, we got to acknowledge it's very high in the country. It's a complex business to execute an infrastructure project in India, right? So the ways, Mr. Kumar, in my opinion, to mitigate construction risk, one of the key risks comes when land acquisition is involved. So is there some mechanism through which availability of land for the IMEC projects could be assured, right? So that if land is there, construction risk is typically lower. Second, we would need to enhance contracting and construction capacity in the country. These are very large projects. And there is, of course, been a significant growth in construction capacity, both in terms of quality and quantity in the country, but we need to do more. Third, I would argue that we need project implementation, monitoring skills, what we call the PMC bit of it, the project management part of it. We need to enhance that too. I think on the question of who provides the construction financing, I have a slightly different opinion than Mr. Vishwanathan, which is that bond markets, in my opinion, typically don't like to take construction risk. Bond markets like to come in when the construction risk is completed to provide long-term takeout financing. So we will need maybe more specialized institutions. I agree with him that commercial banks are perhaps not placed to take that risk. But maybe an institution like NaBFID or another institution which understands the whole complexities of project financing and construction, they could come in and provide such financing.
So the problem has been around that takeout financing in India. We have been talking for a couple of years, but it has not really taken off. So, Mr. Vishwanathan, your thoughts on this, that how does the takeout financing really
the problem is that the people are supposed to take out finance are doing construction finance.
Pardon,
the problem
sir?
is there.
Yeah.
The problem is that people who are supposed to do the takeout finance, maybe InvITs now, but earlier banks, they are doing the construction finance. So what is happening is where the project gets constructed and the whole process is over, then there is a reduction in the rate of interest for the borrower. That's what happens because the people who take out are the ones who already have lent money. So the takeout will happen if the banks are not lending initially. The banks are lending. So how can they take out their own funds? Effectively what's happening, they're taking out by reducing the interest rate for the borrower. So the risk has come down. Yeah. Okay, so I think the inverse is happening. So I think the moment the construction cost, construction risk financing is actually taken by the right agency, you will have the right people to do the takeout. Today the problem is that it's not happening. Okay, number one. And I think the point I was mentioning is, I think I agree with Sanjay, may not be capital, but let's look at NaBFID. What will happen in NaBFID? NaBFID will also raise funds from the public. And public will put fund in that if there is an assurance of the government. See, somebody has to take that risk.
Yeah.
In case the construction risk materializes. Okay, if there is not the capital bond holder, then somebody on who's backing the bond holder is putting the money will have to be backing it. So I think we'll have to find some innovative ways of financing this. You asked whether it's small sum, it's small or large, it's a large sum, undoubtedly large sum, no doubt about it, and definitely has a lot more complications than what would have been something within the country. And I think we have enough examples of our own people, our own entrepreneurs have implemented infrastructure projects elsewhere with change of political guard. They have all been asked to go, right? Those things have also happened. So you have that kind of political risk which actually attenuate the risk in the kind of this project. But as some of the other speakers did mention, the fact that there's a large across the countries involved political support, maybe we have less risk there. But I think it's an important risk that we cannot overlook.
Right. So we have just 2 minutes, and I may probably summarize this. And of course, in 25 minutes, you can't discuss all the aspects on such a complex subject. But my thoughts and based on what the speakers have said, one is inventory of projects would be needed if it has to be kick-started. And not all projects may be greenfield, if I have understood correctly. Some of that may be brownfield, modernization, already generating cash flows. So Gati Shakti could be a good model which could be expanded to include all the projects at one place. And we will need all type of capital, domestic, international, debt capital, equity capital, thought around take out financing, how to make it successful, because commercial banks definitely, they can fund the construction projects where they are assured that after 3 or 5 years, their money will be paid, and an institution like NaBFID, or if the project is complete and there is a visibility of a steady cash flow. InvITs or insurance money comes in when there is a visibility around a steady cash flow. And private capital, it again can be attracted only when there is surety around the risks, particularly like in road projects, what we saw in India, that the projects were initiated but land was not available. That caused a lot of problem. In power sector, the experience was because of the poor health of discoms and the money was not flowing. So there are several dimensions of project financing, and when the project of the nature of IMAC, which is very wide in scope, and I think there would be learnings from BRI already, because that is now running from 2013, and in its scope it was, I think, twice the size, already more than $1 trillion, where we are talking about 500 billion. So some of the learnings from BRI would also come handy. So with this, I think there is on the screen, time is up. We can go on and on this subject, but given the paucity of side, I would like to thank Rajkiran. He had some urgent meeting, so he had to rush. Mr. Vishwanathan and Sanjiv for your taking time and coming this, and thank you to the organizers for inviting me and other panelists for this. Thank you, Anilesh. Thank you, Mr.
Thank you very much, Rajnish.
Thank you very much. Thank you very much.
You're a great sport. The session was delayed, and then, we had to stop you to proceed because of the ministerial address. But I really appreciate your sportsmanship and the patronage which you give to CIO. Thank you very much. Now may I request Jagjeet Sareen to come forward and help us in thanking the two gentlemen. Sanjiv ji, thank you very much. I'm told that you had some busy schedule, but still you could come. Thank you very much. Ladies and gentlemen, you had really wonderful session.